My grandmama and my mama used to love this saying, either you're going to be an old fool or a young fool, but you're going to be a fool at some point. My mom would then follow that up with, an old fool is the worst kind of fool. In my younger days, I mistakenly used that as justification for some of the dumb things I would do from time to time. That I was simply being a young fool, as if somehow being a young fool was better. It wasn't until later in life when I realized that it really wasn't about the dichotomy of being a old fool versus a young fool. It was really about not being a fool, which in the biblical sense is a fool is someone who refuses to listen to wisdom or learn from discipline. Or according to the dictionary, a fool is a person who acts unwisely or imprudently, a silly person. While we were all young and dumb and trying to grow up, so of course we're all going to make a lot of mistakes when we're young and in our early years. The key is that as we gain more experience, knowledge, and wisdom, we're supposed to use that information to help us make better decisions going forward, or we run the risk of becoming a fool who refuses to listen to or learn from wisdom, experience, and or from discipline. As I look back on 2023, I made one of the dumbest mistakes, and sadly, it's typically a mistake new investors make. While it didn't quote unquote cost me money, it did limit the size of my gains. Before I get into the specific mistake, let me explain to you how I fell into one of the most foolish investment traps. And there are three main reasons why. Reason number one that I made this big mistake: I allowed money to make me overconfident. When you first start investing and your financial margin for error is very small, there's a greater tendency to follow Buffett's number one rule, which is don't lose money. Taking it back to behavioral finance, having more money can actually contribute to what is referred to as overconfidence bias, which typically manifests itself in an increased risk taking behavior because you believe your financial resources can absorb any potential losses. It can also lead to excessive trading, poor risk management, and a failure to adapt to changing market conditions. It's important that regardless of our financial status, we remain humble, continually assess our strategy and our investment narrative, and realize that uncertainty and unpredictability are just a significant part of investing. Reason number two that I made this really big mistake: I was being so smart that I was stupid. One of the dangers of being a creator and someone who lives and breathes this information daily is that I typically have more information than an average investor. I hear about more unknown companies. I'm presented with more opportunities than I could ever consider. The real challenge with this is resisting the temptation of equating gains with intelligence. I mean, after all, what's the point of me knowing all this information if I'm just gonna go buy ETFs or other big name stocks? I mean, my arrogance said I need to show how smart I am by finding less known companies and landing several 10 or 15 baggers. I hope what I said sounds as dumb to you as it sounds to me. As we become more knowledgeable and experienced investors, we have to resist the temptation to be overconfident in our knowledge and our skills, because it's not always skills. There are a number of external factors and dynamics that have likely helped us be successful, including just being lucky. This point hit me one day when Rick Rule stated that he could make a very strong case that most resource investors could simply make a portfolio out of royalty and streaming companies and do extremely well. That's when it really hit me. He also said, you can take some of my potential upside if you remove a majority of my downside. Reason number three was the thrill. Like a roller coaster ride, I was enjoying the ups and downs and the volatility of the market, not because it was a necessity of the market, but because I wanted the excitement. I wanted the thrill of being able to say I had X number of 10 baggers. In baseball terms, I wanted the thrill of being a home run hitter that brought people out of their seats cheering at the top of their lungs, as opposed to the shortstop that hits doubles and singles that people only clap for. Completely ignoring that home run hitters are notorious for striking out far more than anyone else. In investing, just like in baseball, you win a whole lot of games by simply hitting doubles and singles and bringing in a lot of runs that way. If you haven't guessed it by now, my biggest foolish mistake of 2023 was all about risk management, risk taking, and risk reward. And this is what I really want you to take away from this video. This slide here represents what most of us have been taught about risk reward, that there is a linear relationship, whereas risk increases, your reward also increases, and as if it's this one-to-one or this linear relationship, and it's simply not the case. I want you to pay particular attention to that final sentence here on this slide. Quote, but if risky investments could be counted on to produce high returns, they wouldn't be risky. Let that sink in for a moment. I can't find the creator's full name, but his last name is Marx, and he proposed that this risk reward graph here is really what it looks like and what we should be prepared for. where that at any given point on the x-axis, there's a whole range of possibilities or possible returns and rewards that you can have, kind of like a bell curve. This graph paints a great picture because it shows how higher levels of risk don't always guarantee higher or lower returns, but rather a range of possible outcomes. As an investor, and especially in the commodities like silver and gold, we know the risk reward calculation is like a graduate level equation with lots of variables that need to be solved for. It depends on where we are in the commodity cycle and even where you invest in the Lassonde curve. We also know that from using ratios and even technical analysis, we can further increase our chances for success and almost create asymmetrical bets for ourselves. This leads me to a quick break. If you're enjoying this content and you want to see more, please do me a favor and hit the like and the subscribe button. My goal for 2024 is to double the number of subscribers to 14,000. So can you help a brother out? Now, let's talk about how I went about fixing my mistake of overexposing my portfolio to risks that I did not necessarily need or didn't necessarily correspond to a comparable reward. First, I went through my portfolio and I significantly increased my holdings in the top 5 or 10 companies in the industry. Second, I increased my holdings in existing gold and silver producers. And third, shout out to Rick Rule because it was him advertising the development stage and pre-production mining companies bootcamp, which reminded me of Lobo Tigre's work, which Lobo referred to as his greatest discovery. In an attempt to avoid being an old fool, I went back to remind myself and relearn the wisdom and the knowledge from Lobo Tigre, which can be found at independentspeculator.com. His report is titled, Put the Odds in Your Favor with the Pre-Production Sweet Spot. This is absolutely a must read. So much so that I would say don't invest another dollar until you read this report. I have placed a link to it in the description for you. Originally discovered in 2017, Lobo released an updated version of this in February of 2023. And the worst part about this whole situation is that I read it within days of him releasing this special report. Apparently, I needed to be a fool for several more months before I really took in all the wisdom he had to offer. So please go to his site and read this report. I was planning to cover the pre-production sweet spot in this video, but unfortunately for me, yesterday I saw that Lobo did an interview with another creator discussing the pre-production sweet spot. So out of respect for that creator, I'm just going to provide a very broad overview. So please make sure you go to his site, get the report, and read the report. But in a nutshell, Lobo identified this time period between a company's decision to build a mine and when they first pour their first gold or silver from the mine. And what he found was that during that time, the average gain from the construction decision to the first pour was 97%. And that companies experienced a 75% success rate. And that the top 5 performers actually had a gain of around 750%. That during bear markets, average gains were only 20.2% compared to 132% during bull markets. So tremendous upside, very little downside. So bringing this discussion full circle, while there is a relationship between risk and reward, that relationship is not a straight line linear relationship like we see in this chart. There's a whole range of bell curve options of rewards that can occur at any point when balancing risk and reward. The goal for us as investors then becomes, how can we find spots where we increase the probability of success in our favor? How can we find those asymmetrical bets? As you've heard me quote Rick Rule before, the greatest risk to the investor and their investment is to the left of your right ear and to the right of your left ear. There's more than enough risk in investing that we don't need to add additional layers of difficulty. There are plenty of ways to go and make very good money that don't require additional levels of risk. Understanding the importance of risk-reward dynamics is vital because it's often a trade-off. But again, it's not that simple straight line linear relationship. Additionally, there is a huge difference between the inherent risk associated with an investment and the inherent risk associated with you as the investor. Both need to be managed. Learn from my mistake and keep overconfidence, arrogance, and even your intelligence level from getting in the way of you practicing KISS. Keep it simple, sucker. While chicks might dig the long ball in baseball, everyone prefers a winner. And hitting lots of singles and doubles is a great way to win at this game because strikeouts hurt. Finally, risk is not something that we avoid. It's something we manage. If you want to go risk-free, go buy bonds and take those returns. For the rest of us, I want to encourage you to enter this year with a level of controlled aggression where risk is managed in such a way that you're able to maximize your upside and minimize your downside. That's what Global Tigre's pre-production sweet spot is all about. That's why it's important that you look at that, because then you can find a whole list of companies where you're placing almost asymmetrical bets and guaranteeing yourself tremendous success. Successful investors, we have to embrace a positive mindset and a proactive approach to risk management and continuously reassess our investments so that we can make changes immediately when necessary. We have to remain vigilant, adaptable to the changing information that we find, and we have to find the optimal risk reward outcome. And that requires a combination of our knowledge, resilience, and commitment to not being a fool, be it an old one or a young one. And before we officially end this video, I also want to encourage you to watch my last video where I went through real examples of how you can manage your risk, decrease your risk, and dramatically increase your wealth by simply taking profits. I'll link to that video here, so make sure you check that out. In the comment section, what was one of your biggest mistakes of 2023? What do you plan to do differently or better in 2024? Or simply put an A+ in the comments to let everyone know that you always stack smarter and never stop learning.